Have you ever wondered why your salary is what it is? Why grocery prices keep going up? Why interest rates suddenly change? Why some countries grow faster than others? The answers to all of these questions lie in two branches of economics: microeconomics and macroeconomics. And here's what most people don't realize. Understanding the difference between these two will completely change how you make money decisions, how you invest, and how you build wealth. Microeconomics studies individual decisions. You, me, a single business, a specific market. Macroeconomics studies the entire economy. All of us combined. The whole system. One looks at trees, the other looks at the forest. And if you can't tell the difference, you'll make expensive mistakes with your money. In the next 30 minutes, I'm going to explain both in the simplest terms possible. No jargon, no complicated graphs, just what you actually need to know to make better financial decisions. Let's go. Welcome to Faceless Millionaire, where we explain investing and economic concepts in a simple way. Now, if you want to understand the systems behind money, investing, and wealth building, subscribe right now. No courses, no BS, just real economics that actually helps you. Hit subscribe. Let's go. Let's start with the simplest possible definition: microeconomics. Micro means small. It studies individual economic decisions. How do you decide what to buy? How does a business set prices? How does supply and demand work in a specific market? Microeconomics looks at individual choices at a small scale. Macroeconomics, macro means big. It studies the economy as a whole. Instead of looking at one person, one company, or one product, macroeconomics looks at entire countries and millions of people at the same time. It focuses on big forces like inflation, economic growth, unemployment, interest rates, and government spending. Think of it this way: microeconomics is studying one tree. Why does this tree grow here? How much sunlight does it get? What nutrients does it need? How does it compete with other trees? Macroeconomics is studying the entire forest. How healthy is the whole forest? Is it growing or shrinking? What's the climate doing to all the trees? How do all the trees interact to create the ecosystem? Both matter. You need to understand your individual tree, your career, your spending, your investments, but you also need to understand the forest it's growing in: the economy, inflation, interest rates, government policy. This is exactly why understanding both microeconomics and macroeconomics matters in your daily life, because both affect you whether you like it or not. Now let's dive into microeconomics. Microeconomics is the study of individual economic decisions and how markets work. It focuses on behavior at the individual level: consumers, workers, businesses, investors. Microeconomics answers four big questions. Question 1. How do consumers make choices? You walk into a store with $50. Do you buy groceries or new shoes? Do you buy the cheap brand or the expensive one? Do you spend it all or save some? Microeconomics studies what drives those decisions: your income, the prices you see, your preferences, your needs versus wants, the trade-offs you're willing to make. This is called consumer choice theory, and it explains why demand exists, why you want certain things and not others, why you buy more when prices drop and less when prices rise. Question 2. How do businesses make decisions? A coffee shop decides whether to hire another employee. A car company decides how many cars to produce this quarter. A landlord decides what rent to charge. Microeconomics studies the incentives and trade-offs businesses face. If they hire more workers, costs go up, but they can serve more customers. If they raise prices, profit per sale increases, but they might lose customers to competitors. Businesses are constantly balancing costs and revenue, and microeconomics explains how they make those decisions. Question 3. How do markets set prices? This is the most fundamental concept in all of microeconomics. Supply and demand. Supply is how much of something is available. Demand is how much people want it. When demand goes up and supply stays the same, prices go up. When supply goes up and demand stays the same, prices go down. This mechanism determines the price of everything: your salary, gas, houses, stocks, food, electronics, everything. If you understand supply and demand, You understand why prices move the way they do, and that understanding helps you make better decisions about when to buy, when to sell, and where to invest. Question 4. How do government policies affect markets? What happens when the government sets a minimum wage? What happens when they tax cigarettes? What happens when they give subsidies to farmers or electric car companies? Microeconomics studies how these interventions change behavior at the individual level. Do higher minimum wages reduce employment? Do cigarette taxes reduce smoking? Do subsidies actually help the industries they target? These are micro questions because they focus on specific markets and specific behaviors. The core principles of microeconomics are simple. Scarcity. Resources are limited. You can't have everything. Trade-offs. Every choice has an opportunity cost. What you give up to get something else. Incentives matter. People respond to rewards and punishments. Markets coordinate. Prices carry information and guide decisions. Competition drives efficiency. When businesses compete, consumers win. Now let's make microeconomics real with an example that affects you directly. Your salary. Why do you earn what you earn? That's pure microeconomics. Supply side. How many people can do your job? If you're a software engineer in a booming tech market and there aren't enough engineers, your salary goes up because supply is tight. If you're in a field with thousands of people competing for the same roles, your salary stays lower because supply is high. Demand side. How much do companies need your skill? If businesses desperately need what you do, they'll pay more to attract and keep you. If they don't need your skill or can automate it, demand is low and your salary stays flat. Where supply meets demand, that's your market salary. If you're earning $60,000 and the market rate for your job is $80,000, you're underpaid. Either you don't know your market value or you're not negotiating effectively. If you're earning $80 and the market rate is $60, you're either overpaid or you have specialized skills that create scarcity, or you have leverage like tenure or relationships. Microeconomics tells you exactly how to increase your salary, reduce supply, get rare skills, specialize, become one of few people who can do what you do, increase demand, work in a growing industry, solve problems businesses desperately need solved, increase your bargaining power, have multiple job offers, build a reputation, create results that are hard to replace. This is microeconomics in action. Supply and demand applied to your career. Most people never think about their career this way. They just hope for raises. But if you understand the micro, you can strategically position yourself to earn more. Let's look at another micro example. Gas prices. Why does gas cost $3 today and $4 next week and then $3.50 the week after? Supply factors, oil production, refinery capacity, pipeline disruptions, seasonal blends. If a hurricane shuts down refineries in the Gulf of Mexico, supply drops and prices spike. If OPEC countries increase production, supply rises and prices fall. Demand factors. Driving season. Summer road trips increase demand. Cold winters increase heating oil demand, which affects gas supply. Economic growth. When the economy is booming, people drive more for work and leisure. Demand rises and so do prices. When supply drops and demand stays the same, prices rise. When demand drops and supply stays the same, prices fall. When both move together, the effect amplifies. This is why gas prices are so volatile. Small changes in supply or demand create immediate price changes because gas is a global commodity market. How do you respond as a consumer? When gas prices rise, you might drive less, carpool more, or buy a more fuel-efficient car. Those are micro decisions responding to market signals. And those millions of micro decisions eventually affect macro outcomes. If enough people buy electric cars, demand for gas falls, which lowers prices, which changes the energy industry, which affects national economic policy. This is the link between micro and macro. Individual decisions at scale become economic forces. Now let's zoom out to macroeconomics. Macroeconomics is the study of the economy as a whole. Instead of looking at individual decisions, it looks at aggregate outcomes, the sum of all decisions, the big picture. Macroeconomics might sound like a complicated word, but in reality, it's simply the study of the economy as a whole. Instead of asking why one product is expensive, it asks why everything feels more expensive. Instead of focusing on one company, it looks at the entire job market. It's not about details, it's about patterns. To understand macroeconomics, you need to understand one key idea. The economy is a system. Everything is connected. Production, income, and spending are not separate things. They are different sides of the same process. When a company produces goods or services, it pays wages to workers. Those wages become income, and that income is then spent on goods and services. This spending creates demand, which encourages more production. This loop is the foundation of the economy. If one part of this process slows down, the entire system feels it. If companies produce less, workers earn less. If people earn less, they spend less. And if spending falls, companies reduce production even further. This is why economies can slow down quickly when confidence drops. This idea is often called the circular flow of the economy. Money and goods are constantly moving in circles. Now let's look at the main players in the system. First, households. Households provide labor. People work, earn income, and decide how much to spend and how much to save. Their spending decisions are a major driver of economic activity. Second, firms. Firms produce goods and services. They decide how much to produce, how many people to hire, and how much to invest. Their decisions depend on demand, costs, and expectations about the future. Third, the government. The government collects taxes and spends money. It provides public services, invests in infrastructure, and supports the economy during downturns. Government spending and taxation influence overall demand in the economy. When households, firms, and governments are all active, the economy grows. When one of them pulls back, the entire system feels the impact. Macroeconomics focuses on four big measurements. Measurement 1, GDP, Gross Domestic Product. This is the total value of everything produced in a country in a year. Every car sold, every house built, every service provided. Add it all up. That's GDP. When GDP grows, the economy is growing. When it shrinks, we're in a recession. GDP growth usually means more jobs, higher wages, and better investment returns. Measurement 2, inflation, the rate at which prices are rising across the entire economy. Not just one thing, everything. When inflation is 3%, your dollar buys 3% less than it did last year. Inflation matters because it erodes purchasing power. If you have money in a savings account earning 1%, but inflation is 4%, you're losing 3% of your purchasing power every year. You're getting poorer even though your account balance is rising. Measurement 3, unemployment, the percentage of people who want jobs but can't find them. When unemployment is low, workers have leverage. Companies compete for employees. Wages go up. When unemployment is high, companies have leverage. Tons of people competing for few jobs. Wages stagnate or fall. Even if you have a job, high unemployment means it's harder to negotiate raises or switch jobs. Low unemployment means you have more options and more power. Measurement 4, interest rates, set by the Federal Reserve in the United States or other central banks in other countries. Interest rates are the cost of borrowing money across the entire economy. When rates are low, mortgages are cheap. Business loans are cheap. Borrowing is easy. This encourages spending and investment. When rates are high, everything costs more to finance. This slows down the economy. Interest rates affect your mortgage payment, your credit card rate, your car loan, and they affect stock prices, bond prices, and real estate values. Let's make macroeconomics real with an example everyone felt recently: inflation. Specifically, the inflation spike from 2021 to 2023. Inflation is one of the most important concepts in macroeconomics and also one of the most misunderstood. When people hear the word inflation, they often think it simply means prices are high. But that's not exactly what inflation is. Inflation means that prices increase over time, and as a result, money loses purchasing power. If something costs $10 today and $11 next year, that doesn't just mean prices went up once. If this keeps happening year after year, that's inflation. Purchasing power refers to how much goods and services your money can buy. When inflation exists, purchasing power declines. The same amount of money buys less than it did before. If inflation is low and stable, this loss of purchasing power happens slowly, 2 or 3% a year. You barely notice it. But when inflation is high, money loses value much faster. This is why holding cash for long periods can be risky in an inflationary environment. Even if the number in your bank account stays the same, its real value is shrinking over time. Why did inflation spike so hard from 2021 to 2023? That's macroeconomics. During COVID, governments around the world printed trillions of dollars, stimulus checks, paycheck protection program loans, enhanced unemployment benefits. More money flooded into the economy. That's the money supply increasing dramatically. At the same time, supply chains broke. Factories shut down, ships got stuck in ports, trucks couldn't move goods, warehouses ran out of inventory, so we had more money chasing fewer goods. Classic inflation setup. The result? Prices exploded. Groceries went up 20 to 30%. Gas doubled. Used cars became more expensive than new cars. Rent spiked. Everything got more expensive. The Federal Reserve responded by raising interest rates aggressively, from near 0% to over 5% in less than 2 years, the fastest rate hike cycle in decades. Why? To slow down the economy, make borrowing more expensive, cool demand, reduce inflation. Higher interest rates mean higher mortgage payments, more expensive car loans, pricier business loans. People spend less. Businesses invest less. Demand falls, and eventually inflation comes down. Did it work? Yes and no. Inflation came down from 9% to around 3%, but prices didn't go back down. Your groceries that doubled in price? They stayed doubled. That's how inflation works. Prices rarely decrease. They just stop rising as fast. And this is why inflation is so damaging to wealth. Once purchasing power is lost, it's lost. You don't get it back even when inflation slows. This is macro. The Federal Reserve using interest rates to control inflation across the entire economy. You can't do anything about it individually. You just have to understand it and adjust your financial strategy accordingly. Let's look at another macro example that hits your wallet directly. Interest rates and mortgages. In 2020 and 2021, mortgage rates were at historic lows, around 2.7 to 3% for a 30-year fixed mortgage. A $400,000 house with 20% down meant a mortgage of $320,000 at 3%. Your monthly payment would be about $1,350. By 2023, mortgage rates had shot up to 7% or higher. Same $400,000 house, same $320,000 mortgage. But now at 7%, your monthly payment is about $2,100. That's a $750 per month difference, $9,000 more per year, just because of interest rates. Same house, same loan amount, but wildly different monthly costs. This is why housing affordability collapsed. It wasn't just home prices rising. It was the combination of higher prices and much higher rates. Your buying power dropped by 30 to 40% almost overnight. People who could afford a $500,000 house at 3% could only afford a $350,000 house at 7%. And this happened across the entire economy simultaneously. This is the power of macroeconomics. The Federal Reserve raised interest rates to fight inflation. And that single policy decision affected every mortgage, every car loan, every business loan, and every real estate transaction in the country. You had no control over it. But understanding it helps you make better decisions. If you locked in a 3% mortgage in 2021, you made a brilliant macro decision, whether you realized it or not. If you waited until 2023, you're paying double in interest. Interest rates also affect your investments. When rates were low, stocks boomed. Money flowed into equities looking for returns. When rates spiked, stocks crashed in 2022. Money moved into bonds and savings accounts that suddenly paid 4 to 5%. This is macro affecting your entire financial life, your housing costs, your investment returns, your ability to borrow, all determined by decisions made by central bankers based on inflation data and economic growth. Now here's where it gets really interesting. Micro and macro aren't separate. They interact constantly, and understanding this interaction is the key to making better money decisions. Macro affects micro. The Federal Reserve raises interest rates. That's macro. Now your mortgage payment goes up. That's micro. You have less money to spend on other things. Your personal budget changes. Inflation rises across the economy. That's macro. Now you demand a raise at work to keep up with rising costs. That's micro. If you don't get the raise, your purchasing power falls and you cut spending. GDP is growing and unemployment is low. That's macro. Now your company is hiring and expanding. You get a promotion or a better job offer. Your income rises. That's micro. Micro affects macro. Millions of individuals decide to save more and spend less. Those are micro decisions. But when aggregated, consumer spending drops. That causes GDP to shrink. That's macro. Businesses across the country decide to automate jobs to cut costs. Micro decisions. But when millions of jobs are automated, unemployment rises. Macro outcome. Everyone wants to buy houses because mortgage rates are low. Micro behavior. But when everyone rushes in at once, home prices surge. That pushes up inflation. Macro result. This creates self-reinforcing cycles. Inflation expectations are a perfect example. If workers expect prices to keep rising, they demand higher wages. Micro decision. If businesses expect higher wages, they raise prices to protect margins. Micro decision. Those price increases confirm inflation expectations. Macro outcome. And the cycle continues. This is why managing inflation expectations is one of the most important challenges in macroeconomics. Once people believe inflation will continue, their behavior helps make it continue. If you only understand micro, you'll make good individual decisions but get blindsided by macro forces. You'll pick a good career, budget well, save diligently, but won't see the recession coming or the inflation surge that erodes your savings. If you only understand macro, you'll see the big picture but won't execute at the individual level. You'll know inflation is coming but won't adjust your portfolio. You'll understand interest rate policy but won't refinance your mortgage at the right time. You need both. Micro for your day-to-day money decisions, career choices, spending habits, budgeting, saving. Macro for your long-term strategy, investment allocation, debt management, timing, big financial moves like buying a house or starting a business. The most successful wealth builders understand both levels. They make smart individual choices and they position themselves to benefit from or protect against macro forces. Now let's talk about the 5 most common mistakes people make when they ignore micro and macroeconomics. Mistake 1, choosing a career based on passion alone without considering supply and demand. You love art history. Fantastic. But the job market for art historians is tiny, and the pay is low because supply of graduates far exceeds demand. That's not a moral judgment. It's just economics. If you want to maximize income, look at where demand is high and supply is low. Right now, that's tech, healthcare, skilled trades, and anything involving AI or data. Does that mean you can't pursue passion? No. But understand the trade-off. Passion careers often require side income or lower living standards. Microeconomics tells you this up front. Ignoring it leads to financial stress later. Mistake 2, holding too much cash during high inflation without understanding macroeconomics. From 2020 to 2023, inflation averaged about 6%. If you kept $50,000 in a checking account earning 0 interest, you lost $9,000 in purchasing power over 3 years, not in actual dollars, in what those dollars could buy. Macro-aware people move money into assets, stocks, real estate, I-bonds, Treasury inflation-protected securities, anything that keeps pace with or beats inflation. Cash is for emergency funds and short-term expenses. It's not for long-term wealth preservation during inflation. That's macro. Mistake 3, making huge financial commitments at the wrong point in the economic cycle. Someone buys a house at the peak of a bubble with an adjustable rate mortgage right before rates spike. Their payment doubles, they lose the house. That's ignoring macro. Someone takes a high-paying job at a startup in a booming sector right before a recession. The startup goes under. They're unemployed in a terrible job market. That's ignoring macro cycles. You can't time everything perfectly, but basic macro awareness helps you avoid catastrophic timing mistakes. Mistake 4, Never negotiating salary because you don't understand your market value. If the market pays $80,000 for your job and you accept $60,000 because you didn't research, you lose $20,000 per year. Over a decade, that's $200,000 in lost income. Over a career, it's life-changing money. Microeconomics tells you to research salary data, understand your value, and negotiate. Most people don't because they're uncomfortable, but discomfort costs hundreds of thousands of dollars. Mistake 5. Making panic decisions during market volatility without understanding the macro context. Stocks crash 20%. You panic sell everything. But if you understood macro, you'd know that crashes are normal. Recessions happen, markets recover, selling locks in losses, or the opposite. Stocks are at all-time highs. Interest rates are at historic lows. The Fed is printing trillions. You go all in on leverage thinking it'll last forever. Then rates spike, markets crash, and you're wiped out. Understanding macro doesn't mean you can predict the future, but it helps you understand risk and avoid catastrophic mistakes. Now let's talk about how to actually use micro and macroeconomics for investing and wealth building, because theory is useless if you don't apply it. Application 1. Use microeconomics for career and business decisions. Understand supply and demand in your field. If your industry is getting automated or oversaturated, switch to one with growing demand and limited supply. Tech, healthcare, and skilled trades are growing. Retail and admin roles are shrinking. If you're starting a business, find markets where competition is low, but demand is high. Avoid crowded markets unless you have a unique advantage. Micro tells you where to compete, where to position yourself, where opportunities exist based on market dynamics. Application 2. Use macroeconomics for investment timing and asset allocation. When inflation is rising, own assets that appreciate. Stocks, real estate, commodities. Avoid holding too much cash or bonds. When inflation is falling and interest rates are high, bonds become attractive. High-yield savings accounts suddenly pay 4 to 5%. When the Fed is cutting rates, stocks tend to rally. When they're raising rates, expect volatility and potentially lower returns. When unemployment is low and GDP is growing, it's usually a good environment for stocks. Macro doesn't tell you exactly when to buy and sell, but it helps you understand the environment and adjust your portfolio accordingly. Application 3. Follow the economic calendar. An economic calendar lists upcoming data releases, inflation reports, jobs reports, GDP numbers, Fed interest rate decisions. These events can move markets because they change expectations. For example, if inflation comes in higher than expected, markets may expect the Fed to keep rates higher for longer. That affects stock valuations. If unemployment spikes, markets may expect a recession and rate cuts. You don't need to day trade based on this data, but being aware helps you understand why markets move and whether your investment thesis is still valid. Application 4. Combine micro and macro for comprehensive financial planning. Micro tells you to live below your means, save consistently, and avoid bad debt. Macro tells you where to park those savings based on the economic environment. Micro tells you to invest in index funds for diversification. Macro tells you when to overweight or underweight certain sectors based on interest rates and growth expectations. Micro tells you to max your retirement accounts. Macro tells you whether to prioritize Roth contributions versus traditional based on current tax rates and expectations about future tax policy. The point is not to become an economist. The point is to have a basic framework for understanding how the economy works and how it affects your money. Most people have no framework. They just react emotionally to whatever's happening. You don't need to predict the future. You just need to understand the present better. And that understanding comes from knowing the difference between micro and macroeconomics and how they interact. Let's bring it all together. Microeconomics, the study of individual economic decisions, supply and demand, how you choose, how businesses compete, how markets set prices, your salary, your spending, your career choices, the trees. Macroeconomics, the study of the economy as a whole, GDP, inflation, unemployment, interest rates, government policy, central banking, forces that shape the entire economic environment. The forest, both affect your wealth. Both matter for your financial future. Here are your action steps. 3 things to do right now. 1. Research your market salary. Go to Glassdoor, levels.fyi, pay scale. Find out what people in your role and location actually earn. If you're underpaid, negotiate or switch jobs. That's micro. 2. Check your asset allocation against the current macro environment. If inflation is still elevated, make sure you own inflation-protected assets. Stocks, real estate, I-bonds. If interest rates are high, consider locking in those rates in bonds or high-yield savings. That's macro. 3. Set up an economic calendar alert. Follow the Fed's meeting schedule. Watch for monthly jobs reports and CPI inflation data. You don't need to obsess over it. Just be aware. That awareness will help you understand why markets move and whether your financial plan needs adjusting. Understanding micro and macroeconomics won't make you rich overnight, but it will help you make better decisions, avoid expensive mistakes, and build wealth faster than people who ignore these forces. Most people go through life reacting to economic forces they don't understand. Wondering why their salary isn't higher, confused why their savings are losing value, panicking when markets crash, making terrible timing decisions. You're not most people anymore. You understand the difference. You know how individual decisions and big economic forces interact. You have a framework for making better money decisions. If this video finally made economics make sense, hit that like button. If you want more financial education without the academic BS, subscribe to Faceless Millionaire. Because I'm breaking down the systems that actually help you build wealth, not the theory that just sounds smart. Microeconomics, macroeconomics. Now you know the difference. Now you know how both affect your money. Use this knowledge. Apply it to your career, your investments, your financial planning. Economics isn't just for economists. It's for anyone who wants to build wealth and make smarter decisions. Thanks for watching. I'll see you in the next one.